Hello, and welcome to the Equity Expert Podcast. I'm Jen Namazi. I'm the Director of Content for the NASPP, and today we're going to be just covering 5 quick tax reporting tips. So it's tax reporting season, and it's time to make sure we're dotting all of our I's and crossing all of our T's, and want to just cover some of the things that come up that you may or may not have accounted for during tax reporting season. So before we jump in, just want to remind everyone that this episode is part of our Equity Expert podcast series. Features a variety of discussions with professionals on trends, career-related topics, and practices within the area of stock compensation. You can find the podcast on our NASPP website, naspp.com, and your streaming podcast apps like iTunes, Stitcher, and Spotify. So let's jump in right away to these 5 tax reporting tips. We're going to hit them quickly so you have a few things to walk away from as you prepare for your tax reporting season. So the first thing is we're going to suggest that you verify employee addresses. Now this sounds really straightforward, but this podcast episode is being recorded in January 2021. We are in the middle of a pandemic where many people are working from home, or they're working from other places, or they've moved around. So this tax reporting season in particular, we want to make sure that we have figured out where our employees are located. So this is an effort probably with payroll and human resources, but we certainly want to make sure that we have verified where our employees are at so that we send their information statements and required tax reporting to the correct address. Now, bonus tip for this one, make sure you extend that to your former employees as well. So we're not just talking about current employees, but if you have former employees with equity compensation and they've engaged in transactions during 2020, then you would need to also be doing reporting for those former employees during this tax reporting season as well. All right, moving on to number 2. So similarly to number 1, we're going to verify our non-employee addresses. Again, for all the reasons in number 1, this sounds like a no-brainer, but you would be surprised. All the non-employees may be moving around as well. So we most definitely want to be able to figure out where they are. I feel like non-employees are probably more likely to have not reported an address change or their temporary mobility or anything like that. And so it's especially important to follow up with those populations. In addition, your non-employees may not be caught up in your normal processes. So they may not have access to the same systems to update addresses or get the same communications. So you definitely want to make sure there's an outreach done there if you're going to have any reporting done for your non-employees. All right, number 3. So this is an important one, also applying to non-employees. So new for the tax year of 2020, the IRS released a new form for reporting compensation. So it used to be a lot of compensation for non-employees was reported on the 1099 miscellaneous form. Starting with 2020 tax year, most non-employee income is now reported on what we call the Form NEC. That's Form 1099 non-employee compensation. Now, there are some exceptions to this. I will point you to some resources in our show notes where we have captured some of these exceptions, but for most intensive purposes, you will be sending out Form 1099 NECs to your non-employees reporting any income incurred from the company, whether that's just stock compensation or from other channels as well. So you'll want to touch base with whoever is preparing the reporting for non-employees and make sure that they're aware of the form change for this year. You don't want to report the income for them on the incorrect form. Now, if you have to make a revision to a prior form, so let's say there was 2019 income to a non-employee and it was incorrect and you found out now that a change needs to be made and a revised form filed, you don't need to use the new form NEC for that. You would still use whatever form you used in 2019. So if it was a 1099 miscellaneous, you would refile that 1099 miscellaneous or update that. All right. I'm going to move on to two last tips, number 4 and number 5, and both of them cover some of our special circumstances related to employee status. So we've got two special circumstances. The first is divorce. So you want to make sure in the cases of divorce that you are correctly reporting income and or taxes for the non-employee spouse. Now, this can get a little tricky. So this is where things vary and go off a little bit differently than they do for regular employees and for non-employees. So there's kind of this in-between of a non-employee ex-spouse who may have engaged in equity compensation related transactions pursuant to a divorce. So the first thing is that if there's any gain or federal income tax withholding that was attributable to the ex-spouse, so this is our non-employee ex-spouse, they are going to get a 1099 miscellaneous. And the reason they're getting a 1099 miscellaneous and not a 1099 NEC is that even though they're not an employee, their spouse or their ex-spouse, who is the employee, that's employment-related compensation. So we are not using the Form 1099 NEC for our non-employee ex-spouses. I hope you're still with me because it can get a little confusing. So you will use that Form 1099 miscellaneous to report any gain or federal income tax withholding for that ex-spouse who is a non-employee. Now, if there was FICA withholding on the transaction. So the non-employee ex-spouse engaged in a transaction, maybe FICA was required to be withheld. That reporting goes on the employee's Form W-2. It does not go on the 1099 miscellaneous for that ex-spouse, even though they did the transaction. It does not go on a separate W-2 for that ex-spouse because they aren't actually an employee. So it goes on the employee's Form W-2, even though the employee may not have actually performed the transaction themselves and didn't actually receive the gain for that. Now, the gain is only reported in boxes 3, which is where Social Security wages appears, and box 5, where Medicare wages appears. So you're going to report the gain in those boxes, and then you are going to report that FICA withholding on the employee's Form W-2. Moving on to our last tip, tip number 5. So the other special circumstance we want to cover is death. And nobody likes to talk about death. It's extremely difficult and unfortunate topic, but the reality is sometimes it does happen to our employees. And so we do want to make sure we are handling reporting correctly in those circumstances. So the first thing to know, when an employee dies and their estate or beneficiaries now has the benefit of their equity compensation, there is no more income tax withholding. So once the employee passes away, that's it. The company does not need to withhold any more taxes relevant to equity compensation transactions. Now, in some cases, there could be a FICA withholding. So remember I said no income tax withholding. This is FICA. This could be different. Potentially FUTA payments as well. Now, when that comes into play is when there is a portion of the options that were vested prior to death. So if somebody had options that were vested prior to death, but they pass away without exercising them, and now somebody else is going to come in and do that, you do need to withhold FICA and FUTA only if that exercise occurs in the same calendar year of the employee's death. So if you had an employee pass away in December, they had vested stock options, and then come February, the estate exercises those stock options. Because this spans 2 different calendar years, there would be no FICA or FUTA on that transaction. So if somebody passed away in November and the estate exercised an option in December, it's the same calendar year. FICA and FUTA is required, and the reporting goes on the employee's final Form W-2 for that year. Now, let's talk about acceleration for a minute, because there are circumstances where maybe it wasn't vested prior to the death, but there is an acceleration of vesting event upon death. So this gets a little tricky, and this is where you want to consult your advisors. So there's a section of the Internal Revenue Code that provides that wages for FICA purposes don't include payments made to employees' dependents as a result of employees' termination due to death, provided that the compensation would not have been paid in absence of the employee's death. So what does that mean? It means that if the trigger for the acceleration was the employee's death and they wouldn't have received that if they hadn't passed away, then there shouldn't be any FICA payments due as a result of that. But it is interpretive. There is some disagreement on this particular position. So I would definitely, if you have this situation where there was an acceleration of vesting and you are wondering what to do about FICA, follow the advice of your tax advisors. So with that, that is our 5 tips that we wanted to cover today. I hope that you learned something. I will post more resources on tax reporting and some of these issues in our show notes for this episode. And as always, appreciate you listening, and we will see you on the next episode.